Okay, today I'm going to go over our speaker for today. We have a wonderful and very experienced speaker here today, Glenn Cardinello. He is a experienced CPA based in Orange County and is a certified construction industry financial professional. He serves business owners primarily in the construction industry, in addition to performing audits, accounting, tax services. Glenn also is proactive in assisting clients in a management advisory capacity. He assists his clients with succession planning initiatives, including ESOP formation and advising in the seller during the process. Glenn received his Bachelor's of Science degree in accounting from State University in New York and Geneseo, New York in 1990. He earned the CCIFP designation, Certified Construction Industry Financial Professional, in 2024, the year the credential was offered. Credential holders passed an exam covering areas including construction industry accounting / reporting, taxation, surety, legal, IT, and HR issues, etc. Glenn is a member of the AICPA, Surety Underwriters Association of Southern California, the American Subcontractors Association, the Associated Builders and Contractors, Associated General Contractors, and served 4 years as president, 10 years on the board of the Orange County chapter of the Construction Financial Management Association. His accomplishments include Glenn has addressed many national and local industry groups and associations on a variety of topics, including management, accounting, reporting, tax, and surety issues. He has authored articles for several trade publications. So please make sure to ask questions while we're here today. Glenn is a very experienced industry expert, and he's here for you to present and to ask and to respond to your questions. Just
All
as
right.
a
Oh, sorry, go ahead.
Yes. Um, we have the slides here today to kind of guide the conversation, but Glenn is really going to be kind of speaking from his industry experience and letting you know what he's seen in the industry as well as just general advice for you. But you will be receiving a copy of the slides after the presentation. I'm going to let Glenn take it over from here.
All right. Thank you very much, Rena. I appreciate that. Yeah, as Rena indicated, I'm a construction CPA. I'm dedicated to the industry. 100% of my clients are in the construction industry. I've been doing this for next year is 35 years. Day one in 1990 when I got into the public accounting profession, got assigned to contractors. My grandfather came from Italy. He was a brick mason, worked with a masonry subcontracting firm in the Northeast. And my father followed him into the field, and they told me, don't go anywhere near construction, back-breaking work, carrying block, brick, and all that, and go to school, which I did. And as fate would have it, day one, I got put on contractors, which was great, and other sectors as well. And, for the first several years of my career, maybe the first 7, 8 years was working in construction, but some other industries, and really like the people in the construction industry, the owners, the people that worked for the construction firms, the people around the construction industry, the sureties, the agents, the bond agents, and others that I got to work with, bankers who like to work with contractors, which are some of them out there, if you know who to deal with. And decided I was going to go full in construction probably 20, 25 years ago. So that's my background. Work with generals and subs of all sorts of sizes. I've got smaller contractors that are doing a few million in revenue a year that we work with. I've got contractors doing upwards of a few hundred million. Most of our contractors tend to be in the 10 million to $80 million range. And I have a great team that works with me on the compliance aspects, doing the reviews. It's mostly reviews that we do. We've got a few audits, but it's mostly reviews that the bond companies will accept, the banks will accept, and tax people that I have working who are experienced in the construction industry as well, dealing with the compliance. I oversee both sides of those core services. The first 7 or 8 years of my career, I'd go out and do the audit, come back, or the review, come back into the office and do the tax returns. So I worked back then, that's how we did it. You would do both. That isn't really how it is anymore in mid-sized to larger firms. But because of that background, I'm able to deal with my contractors on the tax side as well as the financial reporting side. Interface again a lot with the bond companies, bond agents, bankers. Um, Basically like a fractional CFO for a lot of my contractors. So a lot of different issues come my way. We switched this format. We were originally going to do a Zoom presenter format. We switched it to a meeting format because what I want to have here this afternoon, and I think we've got a handful of people on the East Coast here, so it's after 6 p.m. where you are. So this evening, what I want to have is a really valuable use of your time. I'm not one who is big on reading slides, reading information off screens. I have enough information. I've seen a lot of things in my time serving the construction industry that I don't need to be reading a whole lot. What my hope was for this, and originally I didn't even do a PowerPoint presentation. I think part of this format that Meriwether and Williams puts together on a monthly basis is to be able to give you a deliverable presentation. Serena was kind enough to actually do a great job putting this together. Just a quick interview with me, but I've got more I'll cover outside the slides, I think, is where it's going to end up. But this meeting format, in addition to, I guess, is a chat button and a raise your hand thing on these things, I don't think we have a ton of people in here. We've got maybe 40 people plus or minus. You can unmute yourself. You can ask a question. You will not be interrupting me. I want this to, again, to be a valuable use of your time, and I will cover a lot of different areas real quick. I'm going to cover financial reporting, some tax considerations, touch upon the business team that you should be building around you outside your construction firm, some general business discussions as well. I'm going to get a little bit into some examples of that I've seen of fraud and embezzlement in the industry. I'll discuss a little bit about exit strategies. Some of you may not even be thinking about that. Maybe a lot of you may not be thinking about that, but you should be if you're within 5 years of thinking you might want to exit your business, and everyone eventually exits their business. The sooner you plan for it, the more time you give yourself, the more options you'll have available to you, and less chance you'll be doing it frantically in a fire sale type of situation. So those are the top level areas we'll be covering. But again, as I'm talking, something pops up for you, unmute yourself. Go ahead and do it that way. If you want to do the hand thing or the comment chat thing, that's cool too. Ask your questions because there's a good chance that the question that's on your mind is on somebody else's mind or a few other people's mind as well. And that's again where we're going to get the most value out of this time together. So with that, we'll go ahead and start going with these slides a little bit, and then I'll freewheel around it. So the financial reporting system, it's incredibly important for a number of reasons. Too often I've seen where contractors don't have robust financial reporting systems in place and they scramble to put financials together. Sometimes I'll go in and they're not even in the smaller contractor situation. They're not even doing percentage of completion accounting. And they're doing it because all of a sudden they need a bond or the bank line of credit gets big enough where the bank says, hey, you know what? We need you to do a reviewed financial statement. We need something more than what you're giving us. And then, we'll be brought in to help improve the reporting function in that construction firm. But the reality is those financial statements that you're getting asked for by a bond company, by a bank, they're important, obviously, to those outside partners, but they're more important to you as the operator, the owner operator. I do recognize in smaller construction firms that those of you that are intimately involved with your jobs and you're project managing these things as well, and it's small enough, you can kind of see what's going on. However, I will tell you, even with that being the case, the financial statements, if done correctly and communicated to you in plain English, can tell you also a lot about what's going on that you may not see otherwise. Um, I like to, a lot of my contractors, they come up through the field. They're not accountants. A lot of times in the smaller contractor environment, I'll say it the way I've seen it. You got a guy who left his company, started his own construction firm, gets his wife to do the accounting on QuickBooks. I will tell you 80% of the time in those scenarios, the wife doesn't really want to do the accounting, but they're doing it to keep overhead low. And, that's why they're thrown into that role. Sometimes, there's a fraction of them that are very good at it actually and want to do it, but the majority of them, not so much. And, if they have somebody come in, so I've got a team, I talked about my team of people. I have people that have been with me 20, 30 years, who I've hired out of college, who are excellent at training people who aren't trained accountants. who didn't go to school for accounting. You can learn by doing, and you can learn by having somebody translate things into plain English. So for my owners, my operators of these construction firms who are good with the technical building, I will translate those financials into plain English and explain to them what they mean, what the different accounts mean on the balance sheet, on the income statement, on the job schedules, how to interpret those, read those, analyze those, what the bond company is looking for. I really do feel like I could go to work tomorrow for an agency or an underwriting company. I could be a bond agent and do that. I know what they're looking for. I've worked with them long enough that I understand the surety side and surety credit. And so what I bring to the contractor is okay, before the bond company is letting you know what they're looking for, I'll let you know. And you should want to know that. You should know that and be trained on that. So the financial reporting system is incredibly important. You should do at a minimum quarterly financial statements. I say, crawl, walk, and run monthly or better to give you more information timely. The two most important factors in financial reporting are timeliness and accuracy. If I get accurate information late, it's not as actionable. If I get garbage quick, it's not useful. So you have to have both of those things come together at the same time. So, staring at the slide here, credit acquisition. Yeah, obviously, again, if you are timely and accurate, just to segue off what I was just talking about, I tell my contractors, give the financial statements and job schedules to your agent every quarter, whether you're asking for bonds or not. They are your business partner. You want to share information with them. When you have a need, when you do have a need, it becomes easier to get that bond when you're communicating regularly with your outside business partner. Credibility is one of the three C's that they talk about in the surety world, and that boosts your credibility when you're delivering timely and accurate financial reporting information, whether or not you need that bond. So you do that with your bank also. When you want that line of credit, when you want that line of credit increase, your file's up to date. They see that you respect them as a business partner, and so it's a good idea to do that. Trend identification. So I've got a question popping up. Your fees to review financials. So let me just finish off on this trend identification. I'll come back to that, Josie. Um, so trend identification, yeah, this helps you analyze, trends by taking a look. So what I do with our contractors, we have Excel schedules and we build financials quarter over quarter over quarter over year, and present that to our contractors so they can see what's going on, along with the key financial metrics such as working capital, which is just your current assets minus your current liabilities, debt to net worth ratio, your leverage ratio, working capital to your estimated costs and your backlog. Again, that's a surety ratio. We get that communicated as well. So there's a lot of trends you can identify with your job schedules, doing your jobs in progress, doing your completed contract schedules. Both of those together reconcile to your income statement and balance sheet. I'm not going to get too granular here in this meeting. However, they do tie to the dollar. With our team and our contractors, we get everything to work to the dollar. And on the job schedules, you can identify trends such as, what margins do we make with this project manager versus that project manager versus the third project manager, this estimator versus that estimator, this customer versus that customer, these types of jobs versus those types of jobs. I mean, you can really slice and dice the data many different ways. To come back to Josie's good question, what are our review fees? That varies. And that depends. So just like in construction, there's a scope of work that we do. There's the review of your financials. They're your financials. You're responsible for putting them together. The outside CPA firm is responsible for reviewing those financials. There are review procedures that we apply to those financial statements. The two broadest categories, and it's inside your report. If you get reviewed financial statements and you look at the accountant's review report, it says it's comprised of analytics and inquiry. Those are the two main things we do. Analytics is data analysis, and we ask all these questions. We've got a program of questions. That's the inquiry piece. So it isn't to fix your financial statements. It isn't to teach you how to do the financials. It isn't to do 25 journal entries to get the financials accurate. Those are additional outside the scope, and that's what I talk about in the construction industry. You got your base contract, and you have change orders. The contract to do a review with an outside CPA firm, just to do the review procedures, our fees, they range. Ballpark range is probably on the low side in the high teens in that ballpark. We have large contractors we do reviews for that can bump up toward 40,000. So For this audience here, which I think is more smaller contractors, it's probably somewhere in the 18 to $25,000 range, give or take, is the ballpark. I will also tell you that with my contractors, many of whom I have multi-decade relationships, I have a few contractors 30 plus years here in Southern California where I'm working with the children now who are running the company and they're in their 40s now. But I've got those in place and plenty of 20-year relationships and 15-year relationships. Um, the reality is where I am at this point in my career, my billing rate is not inexpensive. I think obviously a lot of value is being delivered. I don't charge all my time. So when I'm working with my contractors and they call and ask questions, uh, my contractors are cool people. And so I enjoy talking with them. I enjoy helping them. And if they've got a 10, 15-minute question they want to run by me, something is going on, even longer than that sometimes, I just don't charge my time. The reason I'm bringing that up right now is because I figure that's included in the base fee for the review and the corporate tax work. On the corporate tax side, most of my contractors are S corps, and we're going to get into that a little bit here this afternoon and evening. S corp versus C corp. Uh, Affordable accounting system do you recommend? That to me is pretty easy. I'll come back to that question, Melanie Fay. Uh, with the corporate tax fees, I don't charge like the individual tax returns. None of my contractors get personal invoices. We do the personal returns for all of my contractors. Those are no charge. I build those into the cost of the corporate return. This way, it's clean. It's a clean deduction. I get a clean deduction inside the contracting firm. And again, the individuals don't get any invoices. In terms of the affordable system, for contractors, that's easy because QuickBooks is generally the answer there. QuickBooks is quite powerful and robust. Um, Years and years ago, and I'm talking 15, 20, 25 years ago, QuickBooks, Intuit's QuickBooks had a negative connotation in the industry. It's like, oh, they're not a serious business. They're using QuickBooks. But QuickBooks has really raised their game in part due to competition coming in from other software options. I know Xero, which is Xero, was one that was doing very well with regard to low-cost accounting solutions. And so QuickBooks and QuickBooks Online really is a good option to go to. I think the desktop may have a little more robustness, but the online version continues to catch up, and that's probably the way I would go at this point. That is the way I would go. Certainly if you're doing under 10 million in revenue, take a look at QuickBooks. You can probably get the job done. Most of my contractors, even using other systems like Foundation or Sage 100 or Sage 300, they still use Excel for the job schedules. Excel is so flexible and powerful, and I recommend that, and you can couple up the Excel with the QuickBooks. The thing is, regardless of the system you have, you need to have a really, really good operator. You can give me the best jackhammer or backhoe in the world and put me on it. I'm not going to do a good job with it because that's not what I do. So you need to have somebody who knows how to do the construction accounting. Um, I'll use this as a quick opportunity. We have a group in my firm that does the accounting for contractors. When that happens, I can't do the review because we're not independent. I hire another CPA firm. I work with them and we get the review done that way. It's pretty seamless. Whether it's our group that does it, there's plenty of people out there that you can find. But you got to make sure they know construction accounting, that they know percentage of completion accounting, and that they're reliable and that they're going to be there month in, month out, operating in QuickBooks for you, or you hire somebody internally. But QuickBooks is the answer to that question. So with that, we'll keep rolling through. Are there any other questions? I'll pause and I don't know in the chat, Rena, or anywhere else if there's anybody else asking questions I missed. Yes, they do. QuickBooks absolutely has a specific contractor accounting platform, and you can job cost, and you must job cost. You have to job cost, whether you're using QuickBooks or anything, job costing is what it's about. And, you have to have the ability to bid your contracts accurately. You have to know how to estimate and do takeoffs and be reasonable and every month develop your cost to complete. If you're doing your financial statements every quarter or every month, you need to, the way that process should work, and I'll take this opportunity to go through that process. So you've got project managers that are reviewing the jobs. You should be having weekly job meetings, if not weekly, bi-weekly with your project managers. I recognize, again, in smaller construction firms, there aren't too many of those. Maybe you got one or two. You're probably doing a lot of it. You have to communicate. So first, the accountant who's doing your financial statements needs to give to the PM actual cost to date. So right now we're in the middle of December, should be working on November 30th financial statements. I, as the accountant, internal accountant, should be giving to the PMs, hey, here's your jobs. Here's all your jobs, inception to date job costs. I need you to give me cost to complete from December 1st, 2024 through the completion of those jobs. Apples to apples with the costs you see here. There's direct costs and there's indirect costs. Direct costs are those that are easily allocable to the job, such as direct labor and materials. Indirect costs could be things like depreciation or workers' comp insurance, payroll taxes on the labor. So there's a whole indirect cost section of the contract cost schedule. The sum of those two are your total contract costs. But again, the accountant gives the project managers actual cost to date. Project managers review that and they say, okay, from December 1st to the end, here's my cost to complete. I also recommend building a little bit of contingency into all my jobs because construction, things can go south. There's another reason to build contingency, and particularly once you have a strong balance sheet. And by contingency, I call it cookie jarring, sandbagging a little bit. Basically, contingencies in your budget so that you're kind of a little bit underreporting where you think the job profitability will come out. You do that to protect for real contingencies, but you also do that because we don't want job fade, and the bond companies don't want to see job fade. And smaller contractors, this doesn't matter so much for tax because you're not paying on the percentage of completion. Most smaller contractors, in round numbers, 25, 30 million annual revenue or less, you're probably on the cash
Nobody's worried.
basis. Did you have a question, Burdette? All right. So, you're probably on the cash basis method. Most smaller contractors are, so it doesn't matter for that. But what it also does do in terms of building those contingencies while those jobs are in progress, you're basically taking profit off the income statement, putting it up on the balance sheet as more overbillings or less underbillings. And then, you do that every year. You roll the cookie jar, you roll the contingency package, and then when the cycle goes low and you're having a tough year, those cookies get emptied out and it doesn't look as bad on the financials. It's a little bit of a smoothing mechanism, but for larger contractors, it affects your taxable income. And it's a good thing to do for that reason. Rena, do you see any questions or should I keep rolling?
See one more. It says, do you have a system or a way which helps companies always make a profit?
Do I have a system or way to ensure companies always make a profit? Obviously I have no magic wand, but I can speak to that. I mean, it's general business strategy and philosophy, which is to say, just like I do with my business, I have a premier team of accountants on the financial reporting side, on the tax side, on the consulting side. I've got an HR person, I've got the IT people for my contractors, and I just get top-notch people on the inside. Then next, I make sure that the people I work with are good people. If I work with good and fair people, and I have good people and fair people on the inside of my team, everything else will follow. I know that sounds basic, but I mean, that is what it's about. If you have good people technically and good people from a character perspective, which by the way is another C of the surety underwriting, character. They want to be dealing with good people. And we all want to be dealing with good people. If you're a subcontractor and in your market, a GC is just difficult across the board, and that's very few of them. Most GCs are great to work with. However, there are sometimes, some that are difficult. Or a customer. Like I was at lunch today, LAUSD here in Southern California. LAUSD, we got to work with them, but you got to know how to work with LAUSD or you're going to get hurt, in terms of the way your billing works and everything. There's different intricacies with certain customers. Another thing I'll talk about, and I wrote an article on this. If you Googled my name, I used to maintain a blog site. I used to write more regularly. I haven't done that in a few years. But I wrote an article on marquee clients. So like here in California, in Northern California, Apple Campus 2, contractors tripping over themselves to be part of this big, big project with big, big Apple. Oftentimes when you go into marquee projects, SoFi Stadium was another one. You get into these big marquee projects, these, sort of ones you can put forward. Hey, look, we worked on this project. A lot of times they're difficult to work on and they will hammer you, so like I'm nervous when I see any of my contractors chasing marquee name projects. Be careful of those. Be careful of big contract sizes. The higher you fly, the harder you fall. I'll take the opportunity now to say, in construction, there's an old saying, every contractor is one bad job away from going out of business. So, if you get into a contract size you're not familiar with, a technical area you're not familiar with, a geography that's not close by because it's difficult to supervise. You're in a certain part of the country and you're going 6 hours away. that's difficult sometimes to manage unless you've got your top-notch person out there on site, living out there, it's difficult. Things can get away from you quickly. So stay within your wheelhouse, know what you're good at and what you're not good at, and surround yourself with good people and good customers, and you'll do fine. And never be complacent and work really hard. I mean, that's all I can, that's what I can say to address that question. I mean, it's again, basic blocking and tackling maybe, but those are some top level thoughts and considerations. Anything else, Rena, in the chat or question box? No?
What I
All
see.
right. So here, I'll go through these somewhat quickly. I think most people understand that you have a balance sheet. So, the balance sheet is incredibly important. That is the accumulation of your financial performance as of the date of the balance sheet. The difference between a balance sheet and the income statement, one of the differences is the balance sheet is a snapshot of a picture in time on literally one day. What are my assets? What are my liabilities? What's my leftover, i.e. equity? And then within the balance sheet, there are certain metrics that I touched upon a little while ago that are very important for you, for your bank, for your bond company. Working capital, current assets minus current liabilities. And when we talk about current assets, those assets must be good quality. What I mean by that is if you are BSing your estimate on a job in progress, you're not going to really make that money. You're just hoping. And it may not even be you. It could be your project manager who is not really coming clean, that they're in trouble on the job and they're 80% done and they're really not putting in the right cost to complete. You may have an underbilling popping up and it's a large underbilling, and that's in my current assets, but that's not good quality because that underbilling, which is a debit on my balance sheet, if that's not a good estimate, that part of that debit probably belongs on my income statement as a reduction of revenue. So it's not a good quality asset. So that's part of what we do as CPAs. We come in and make sure the quality of the reported assets are good. We ask questions. We kick the tires. If I see large underbillings, I'm going to be all over those because that's sometimes indicators of trouble. Not always, but a lot of times, especially if it's 80, 90, 95, 98% done. So current assets minus current liabilities, working capital, got to be good quality assets. Then you've got that leverage ratio, which is your total debt divided by net worth. And you want to have that to be a low ratio, a lower number. I'm a big believer in being very tightening my belt in the early years of my business, building up that balance sheet strong, because once I get to a strong balance sheet, then I can be, I have, some optionality with how I make decisions. I can throw my weight around a little bit. I can use like the Walmart example or, big corporations that once they're strong, they throw their weight around and the rich get richer. And this is true, and same thing with contractors of all sizes. Just get that balance sheet very strong. Income statement, different in that where the balance sheet shows you one day in time, the income statement is a period. It could be a quarter, it could be a 6-month period, oftentimes is a year. And that shows the results of operations for that year. And so, your earned construction revenue, that's, with percentage of completion accounting, which is what you should be using, it's not about what we bill our GCs or our owners of projects. It's about the work we put in place. And that's that percentage of completion calculation, which is your total costs divided by your total estimated costs, your actual cost to date divided by your total estimated costs, you come up to a percentage, times that by the contract amount, that's the revenue we get to recognize in the income statement. I think I'll take this opportunity. I talked about percentage of completion. I used that term a few times now. There's no easy way in this format to say, hey, how many of you know how to do percentage of completion calculations? I'm going to assume not everybody does, because that is, yeah, good job, Rena. Yeah, that is so important, this screen right here. And so what I'm going to do, and I don't know, what the percentage is, but there's some percentage of people in this meeting that don't exactly know how it is calculated. And I'm going to run through it real quick. So I've got this job here. I use small round numbers to make the math easy. I've got my job that I bid. I think it's going to make me $20,000. It's going to cost us $80,000 to put $100,000 worth of work in place. And through the date of these financials, whatever date that is, let's call it November 30th, 2024, I've spent $20,000. My percentage of completion on this job is simply, you probably don't see my screen, but it's 20,000 divided by 80,000. It's that middle column on this screen. You take your actual cost divided by your total estimated costs, and you get 25%. I get to recognize 25% of that $100,000 or $25,000 in my income statement. But in my general ledger right now, and I'm going to say I'm a subcontractor in this example, I've got 20,000 of receivables that I've built to date. That includes my retention piece. So in my general ledger right now, I've got 20,000 of receivables divided by current receivables and a couple of grand of retention. The other side of that is my revenue, 20 grand. So in my QuickBooks, let's say it is, I've got 20 grand of revenue, but I'm allowed to recognize 25 grand. Now here's what I do. What's called the WIP adjustment, the work in process adjustment. And what I do is the journal entry is to increase my underbillings, a debit to underbillings, increasing my asset, $5,000. The other side is a credit to revenue, credit to income of $5,000. That is that $5,000 credit to income is added to my already 20,000 of revenue that's in my system. The sum of those two is 25 grand. So now I've got an asset on my balance sheet for 5 grand of underbillings. I kicked in another 5 grand to my revenue, and that's how I get my revenue right sized to the 25 grand I'm allowed to recognize. So I'm going to pause here. Does anybody have any questions on how to calculate percentage of completion? Just unmute yourself or put a thing in the chat or raise your hand. But it is really as straightforward as that. Now, this is one job and it's super easy numbers. The estimated total cost of 80 grand is the incredibly important piece. That is subjective. That is not, it's called an estimate for a reason. That is going to change by the end of the job. But that's the one that we want to make sure that I'd rather it be 75 grand when I'm done than 85 or 90 grand. When it's 85 or 90 grand, and I said to the world it was going to be 80 grand, now I'm experiencing what's called profit fade. Bond companies hate it, you hate it, I hate it, we all hate it. So, if I think it's going to cost me 75 grand, I'm probably going to put 80 grand in that column. That's my contingency planning, just to give myself a little bit of headway in case something goes wrong somewhere on the job. By the way, subcontractors in the room, subcontracting is more difficult with regard to this issue. And really, probably, the business model itself is a little more riskier than being a general contractor. With a general contractor, I'm dealing with fixed price subcontracts. A subcontractor is tasked with managing labor and materials costs that can change, unless you've got protections in the contract. But I mean, labor is a big piece of it too. I mean, lack of productivity, changes in conditions, which maybe should be change orders. Sometimes we don't go for those change orders, but change order management is incredibly important. That question about how can you ensure profitability, avoid scope creep, change order management, early identification and communication of change order opportunities, get them approved as early as possible. Change orders are absolutely massively important, as you all know in this room here. But that's another thing to definitely keep in mind. I saw something come through.
Elton was asking.
Melanie, yeah, let me hit some of this. Melanie Fay, you're welcome for stating weekly or bi-weekly. They're important. Those job meetings are incredibly important to get people around the room. It was always physical in the past. Sometimes now it's virtual, although I prefer it be physical in your offices. This last thing here, a list of important ratios as an Excel attachment afterwards. Yeah. I'll tell you what, if you want that list of important ratios, just let Rena know. She'll let me know who you are, and I'll make sure to get them to you. I can get some ratios over to you. And those are ratios that are important to you as a business owner, but again, important to the bond company and bank as well. So we can take care of that. I think everyone's good with percentage of completion, Rena. I don't know where we were in the slide deck. If you can go back to where we were. Statement of stockholders' equity. So the statement of stockholders' equity, as the name implies, is basically the retained earnings is a big piece of it. What's left over in the business that's kept in the business, right? I mean, if you distribute money out, and I'll say, be careful with your distributions. Don't take distributions that aren't for tax purposes, especially early on in your business. You can take them later, but take them knowing that your bond company or bank is not going to have a problem with it. If you're not sure, don't take them. If you're not sure, talk to your CPA, your bond agent, or your banker before you do it. I don't think it's a good idea to ask for forgiveness rather than permission. I do think it's a good idea to ask for permission first, because at least talk to your CPA. If they're a good CPA that's consultative, like my deal is, what I bring to the table, I'm not looking through the rear windshield of the vehicle, which is what most accountants are doing. And in fairness, that's our business. You're doing financials as of 2023, last year, a few months ago, September 30th, whatever, the tax returns for last year. My job is to look through the front windshield and advise. And this is an example. I'll have contractors call me, hey, can we do this? Yeah, you can. Yeah, I don't think you have to give a heads up. We're so strong, we're good. Yeah, you can. We should probably give a heads up. I'm not 100% sure. Let me check. Because, the bond agents and bankers at this point, I've been working with these people for so long, they're friends of mine. And if I have to check, I'll check. But it's a good idea to ask if you're not sure, especially again in early phases of the business or when the balance sheet's not very strong, double check those things. So it's quiet in here. Are you all done? I will be leaving in 1 minute unless I hear someone talking. Can you all hear me? Rena, can you hear me? So you're on mute, but I see you say yes. So I think Ronnie's probably having his own. Everyone else is good, right? You don't have to put yes in there, but if you're not, just put no. I'm assuming everybody can hear me. So yeah, again, the statement of stockholders' equity, I was talking about distributions, that would come out and that would not be retained. So your retained earnings is, as the name implies, what you've retained. And that's an important number to get big. You want that number, I'll give you a metric. One goal would be to get your stockholders' equity to be equal to or greater than your total liabilities. Equal to or greater than your total liabilities. When you do that, you start to become best of class. When you do that, you'll get better deals with your bank and bond company. When you do that, you'll sleep better at night. You'll have so much more optionality with different business decisions. So that's a good ratio I'll give you right now, a good goal for everybody. Get your statement, your stockholders' equity to be equal to or greater than your total liabilities. So there's one. Cash flow statement. So the cash flow statement is often ignored by people. I enjoy going through it with my contractors because it's very interesting. Basically, it essentially takes accrual / percentage of completion financials to a cash basis and shows what your business is throwing off from a cash perspective. There's three main areas of the cash flow statement. There's your operations, investing, and financing activities. Operations is, as the name implies, what is from your operations, and you can see positive or negative. When you're growing, when you're going from 3 million to 5 million to 7 million, your cash flows are probably going to be negative in the operations because you're financing new work. And that's normal, but you've got to be careful how you grow. You've got to grow carefully. There's an old saying that you can grow yourself out of business. You can take on too much. You can bite off more than you can chew. This is why working capital to estimated backlog cost is important. You don't want that number to get too stretched on that ratio. So, cash flow statement is interesting too. I just spend like a minute or two kind of going through that as I'm doing my meetings, my year-end meetings. That's usually once a year that I go through the cash flow statement. But it's a good one, and it's a required part of the basic financials. Next slide, Rena. Well, here we go. I've talked about it a bunch already. These three. There's some, and again, we'll get something aggregated for those that want key financial ratios. We'll throw a few out there for you, get them over to you, but I'm not going to spend more time. I've already kind of touched upon these here. Gross profit margin, SG&A. So on the gross profit margin, something that I also find interesting is you'll go into different contractors and the way the accounting is done when we first get in there sometimes is not the way we want to go about it. And what I mean by that is the gross profit margin is your revenue minus your contract costs. And there I want to move as much as I can up into my contract costs as possible. Remember I said there was direct and indirect. The direct are easy to identify and the indirect are less clear, but should be allocated up. I'll give you an example of like rent. Say I'm in a building and I've got 20% office space and 80% operational space. It could be a warehouse or a yard or whatever. I'm going to break out my rent expense 20% to my SG&A and 80% to my contract costs, my indirect section. Because you don't charge rent to the jobs directly, but I put it into an overhead pool and we spread it ratably over all the jobs. The reason I want to get more out of my SG&A and up into my contract costs is the lower my SG&A, the lower my break-even point is. There's a lot of variability in the contract costs, certainly the direct costs, but even in some of the indirect costs. And the lower I can get my SG&A, the lower I can show my net monthly break-even point. because that's another thing the bond company and the bank will look at, and you'll look at. Um, my SG&A, well, I have it written here. It should be somewhere in the 8 to 12% range. Sometimes, we'll see that spiking up into the high teens. The lower, obviously, your revenue. It's a function of math. If you have lower revenue than you normally do, your SG&A percentage is going to go up. But, at some point you better right size things or else you are going to go out of business. So, as your revenue decelerates, sometimes you've got to unfortunately cut labor. Sometimes that's not a bad thing, though. I'll tell you, in the construction industry, when things are super busy, it's hard to find people. I'd suggest that there's a small percentage of people in the field that have no business being in the field. They shouldn't be on a job site. They could cause safety issues or other issues, inefficiencies. And you might look for an opportunity to get rid of the bottom 10% of that field labor force as revenues come on down, and you don't foresee them coming up anytime quick. Protecting good people is important too. If you've got good people, obviously you can carry them for a little bit if you've got, again, that strong balance sheet. But yeah, the gross profit margin is simply, again, the revenue you've earned on the project minus your direct and indirect contract costs, and the SG&A is the back office overhead. Another way for me to talk about SG&A is those costs that are required to operate a business, any business. It's not just because you're a contractor, but any business has to have rent, electricity, and utilities and these other things, and office people that are doing the accounting and things like that. So that is just germane to any business. And the things that are really related to the construction operations, like that warehouse or yard, um, your workers' comp insurance, move that up, move that into your indirect costs. So let's move to the next slide, see what we've got next in this PowerPoint presentation. This I'm going to go through very quickly because the most prevalent way in almost all cases is cost to cost method of calculating percentage completion. I learned in school how to calculate those different methods. I learned as a young CPA these different things. I've employed different methods maybe like a couple of times in my career back in the 90s. I haven't done anything other than cost to cost since then. Cost to cost method is what you all be using. It's your actual cost to date, dollars and cents, divided by your estimated total cost. But, to give you one other example really quick, if I was going to do 100 miles of road and I've got 30 miles done, I'm 30% complete. That's another units of delivery. So, yeah, that is done in certain trades. I don't have that. I don't have any road builders. So I don't do that, but most of it's cost to cost. And I think as I looked at the list of people in different industries represented here, it's going to be cost to cost. We can go to the next slide, Rena.
Yeah, I had a question in the chat. I'm not sure if you already addressed this, but it says, I thought S Corps needed to have pass-through profits every year.
Oh, I see it. Yeah. No, there's no requirement for what you might be talking about, George or Jorge. I apologize for pronouncing, it's one of those, right? We'll go with George. What you might be referring to is that those flow through profits have to be reported on your tax return, but you don't have to distribute them. But it has to go on your tax return. Every year, all of your income, whether you distribute it or not, is going to get reported on your K-1 on your tax return. But again, like I said earlier, your distributions, unless you're very strong already, should be limited to what you need to cover the taxes generated by your construction firm. If you've got big tax bills because you made a ton of money in the stock market, use some of those gains to pay that portion of your tax bill. Don't use the S Corp profits to pay a big tax bill because you made it in crypto and sold your crypto out or whatever. That might be what you're referring to. You have to pay the taxes on all of it, whether if you're out there, George, can you just tell me if I hit that right? Is that what you were thinking? But that's basically it. You've got to report it on your tax return, but you don't have to distribute all of your profits every year. No, no. Cool, cool, George. Thank you. Yeah, you're right. It's a good point. That's a good point that you do have to report it all on your tax return. Let me real quick while we're talking about S corps. Let me real quick talk about S corps versus C corporations. So a few times, less or so in recent years, as people are more familiar with S corps, but a handful of times over the years, I get people asking, but isn't a C corporation better liability protection than an S corporation? No, it is not. It is not. It is just a different form of entity in terms of who is responsible for the taxes, like we just talked about with George's question. There is no difference in liability protection. One of the big reasons to be an S corporation is on the exit. Uh, Most deals in the construction world are going to be like, say somebody's going to buy your company, it's going to be an asset deal, not a stock deal. The reason being, I wouldn't buy stock in your construction company because there's latent defect, warranty work, or, you know, years after you get off a job site, you can get sued for that job. I don't want to buy your stock and then be responsible for latent liabilities from a job you did in 2022 that I have no clue about and you didn't disclose. And, I just don't want to deal with the skeletons in the closet. I'm going to do an asset deal. I'm going to buy your assets. And that is the way it's generally done. It's an asset deal. Who owns the assets? The company owns the assets, whether it's a C corp or an S corp. And an S corp, if I sell for 10 million bucks, and an S corp, 10 million goes into the S corp, and then I need to distribute that out because I want to retire, right? I sold my business. I'm going to pay taxes only at one level, the individual level, and I'm going to lose, 40%, let's say, but I'm going to be left with 6 million bucks. If it's a C corporation and it's an asset deal, and I've literally in my career seen a handful of deals get shut down when the owner realizes he's a C corp and nobody ever told him about S corp, and now he's trying to sell his business, and the buyer only wants to buy assets, and that 10 million goes into that C corp, the C corp's a tax-paying entity, and you're going to lose 30% there, you know? And now you're going to distribute out the difference. Now you got 7 million left, and you're going to pay 40% in taxes, 2.8 million. Now you're going to be left with, like 3 or 4 million bucks, 4 million bucks instead of, 6 million bucks. You're going to lose double taxation. C Corp gets double taxed. And that's one of the main reasons why S Corp is a good model. Yeah, so generally that is a huge difference between S Corp and C Corp and why you'd want to be an S Corp. Underbillings and overbillings, I've touched upon this a little bit. Underbillings in a subcontracting environment, if you look at all the jobs in progress, you're probably going to be net underbilled. Unless you're a specialty contractor in like a technical, like a medic. I've got a bunch of healthcare contractors. They're subcontractors, but they can bill, a little more aggressively, so they'll be overbilled. But your general subcontracting trades, grading, HVAC, plumbing, typical subcontractors, steel, you're going to be underbilled net on the net because you're going to put the work in place before you can bill for it. General contractors are typically overbilled. Job borrow is the term that we use in the general contracting world. We're using the owner's money to finance the projects. So you'll be net overbilled typically, and typically you're not going to need a bank line of credit as a general contractor. You shouldn't need a line of credit as a general contractor if you're doing the billings the right way and using that job borrow. And you can read on the screen, different characteristics of the underbillings and overbillings. I'll pause as you're reading the screen. Again, I've touched upon it earlier in our talk. If you've got any questions, pop them in the chat here or unmute yourself, and I'll come back and answer questions on underbillings and overbillings. We can move on. Tax methods for contractors. So I think, again, most of the contractors in this room are smaller contractors, not subject to the requirement of percentage of completion for tax purposes. You are likely on the cash method. The cash method, as the name implies, you only pay tax when you collect the cash. You only get a deduction when you pay the cash. You don't get to deduct your accounts payable. You don't pay taxes on your accounts receivable. There is an alternative minimum tax system, AMT system out there that your CPA may have told you about. The reason that's out there is the government recognizes they're essentially giving you an interest-free loan when you're a cash basis taxpayer. You're getting a deferral. I always, once a year, communicate what that deferral is to my contractor so that they know how much they're going to owe at some point in the future, and it will turn around at some point. It could be several years down the road, but at some point it'll turn around. And one way it can turn around is if you get to be a large contractor and you get forced onto percentage of completion, which is, again, as you approach 30 million a year average annual gross receipts over a 3-year period, you're going to be flipped off of cash and onto percentage of completion method. You're going to be forced to pay back that deferral. And I tell my contractors a couple of years in advance and a year in advance as we're getting towards it, you're going to owe this 7 digits usually. This 7-digit deferral is coming back the other way. As you get to be larger, that deferral builds up. So you're still doing percentage of completion financial statements, but you're allowed to have a different method of accounting for tax as a smaller contractor for your tax returns to get the advantage of that interest-free loan from the government. So that's the cash method, which is what most people will be on. Accrual methods out there too for contractors, not too common. I'll just spend a few seconds on that. Basically, if you bill it, you're going to pay tax on it. If you bill it, you're going to pay tax on it. It strips out your over under billings, but it leaves your billings behind. And so if you bill it, you'll pay tax on it. Percentage of completion is basically the way your financials are presented, is the way the accounting is going to be done for the tax return. And so as we are stronger again with a strong balance sheet, I like to have a good cookie jar that I build up. Like I said earlier, it is good for tax purposes to be conservative. There is a look back requirement the IRS puts forward, but they don't understand it themselves. They don't enforce it. Never been an issue. It is out there, but you reduce the profitability in your jobs in progress. Your financial statement's going to be a little bit lower. Some of the income's going to be on the balance sheet. You'll eventually recognize it, but again, we build up a new cookie jar with new jobs in progress, and it reduces our tax liability. That deferral can be a substantial deferral when you're a larger contractor. So you can get a deferral even as a larger contractor. There's different ways to play the game depending on what method you're on. Complete a contract method, as the name implies. If you are done with the job, that's when you pay tax. You don't pay tax on the profit of your jobs in progress unless they are 95% complete or more. And again, even with that method, all of these, they're called exempt methods. The government recognizes they're letting you not pay as much tax as you're really earning. So they have this alternative minimum tax calculation that we've got to do to kind of not let you get too far ahead of the government. So they'll have you pay in a little bit sometimes of the AMT, depending on the way the calculations go. So I'll just throw that out there. Any recommendations for how to plan financially for the deferral percentage completion? Yeah, I mean, it's not that difficult. So you need to, again, if you're stronger, it's easier to do. If you're still building your balance sheet, you don't want to do it quite as much. You want to have very small marginal contingencies in your budget. But Melanie Faye, it's simply just adjusting your estimated total costs. Remember our percentage of completion calculation we did earlier in this meeting. The denominator is your total estimated costs. If I make that number bigger, my percentage of completion will be smaller. If my denominator is bigger, my percentage of completion will be smaller, and my revenue recognition will be smaller. It doesn't change the economic reality of your jobs. That's going to happen in the field, the execution, your change order management, your billing and collections. It is just on paper what we're reporting, right? So, again, I'd rather be a little conservative. If I'm strong already, I'm going to be a little bit even more conservative. I have more latitude there. So cool, Melanie. Melanie, I see you got that. All right, we can go to the next slide and see what's next here. Yeah, I've talked about this already. Operational job meetings, where you're doing those weekly or bi-weekly, getting everybody around the table, making sure, because the question I got before about how can you assure profitability in a construction firm, by having a good team and having good communication within your team, having good communication with your GC and or your owner, your other business partners you're executing with, that you're putting the work in place, put good work in place on time, on budget. And communication is the cornerstone of all good things in business and in personally with your spouse, with your children, with your family. Communication is critical, and having these meetings, preferably in person, is the way you want to go, and doing that regularly. Because, when you get larger and you've got multiple PMs, for example, the second PM may say to the first PM, you know what, I dealt with that a few years ago. Here's how I handled it. Here's how you get in front of it. And then PM1 gets better by PM2's experience. Even though PM1 didn't have that experience in that meeting, knowledge was transferred and communicated, and the solution was arrived at before a problem occurs. So these bullet points here, incredibly important for having good and productive operational job meetings. Go to the next slide, Rena. Thank you. Talk about change order management. Early identification of that change, early communication of that change to your customer GC, getting that proposal, negotiating that change order and getting it executed. I know that not all change orders can be approved in writing before the work gets done. I understand how it goes out there in the field. That being said, depending on when you're working with a GC that you have a good relationship with, and oftentimes within that GC, it's that their PM, that the individual. It's all about individual relationships. That communication again, early and often is important. Sometimes, I see that, oh, I can't give it to you on this job, but I'll get you on the next job. If you can trust them, and you have good experience with them, yeah, you probably will get it. I mean, I see that on a regular basis, but preferably you want to get it on this job. So again, change order management is critical. We'll go to the next slide. This is very important here. Um, and again, thank you to Rena for building out this PowerPoint. This is very nice. When you're a construction company, you're a subcontractor or a GC, you don't want to work with a CPA. You want to work with a construction CPA. You don't want to work with a CPA that works with like three or four or five or six contractors because that's not enough. You need someone that's in it deep, and they're out there in all the different markets around the country. You just got to find them. So, same thing with a banker. I mean, the surety broker by default, surety broker, 100% of the time they're working with contractors. The underwriter, they're working with contractors all the time. They're very knowledgeable. And by the way, I'll take this opportunity to say, use your construction CPA, your surety broker, your construction banker, someone who knows it, very well. Use them as consultants. Use them as consultants. You have something going on. Chances are they've seen it, and if they haven't seen it, they've got a network themselves. This is your network. Well, I've got my network, can bring somebody in to help you out on whatever the situation is. I just had a contractor, I just picked him up a couple of weeks ago. They're having problems chasing money. I've got an attorney in San Diego that is the best at chasing money in the construction environment. So, I connected them with that attorney and, I'll use the term Rolodex because I'm that old, but, I've got a network that's pretty deep in the construction industry. So getting people, getting your attorneys are also important. Building out that network that is construction industry specific and deep, inch wide, mile deep is what you want to do. And I'll go on to say, it's also a good HR person. Most of my contractors don't have internal HR people. So finding a good outside HR resource is important. In my firm, I've got a lady in the Midwest that works with my contractors on a pay-per-use basis. Very modest charges. I see the invoices going around, not too much. And what are they using it for? They're using it for things like an employee handbook, building an employee handbook, updating the employee handbook. They have an executive who's saying the wrong things, politically incorrect things in the workplace, and we need to deal with this person. We're looking to exit somebody, getting somebody out. Make sure we dot all our I's, cross all our T's so that we mitigate any wrongful termination lawsuits. So you talk to this HR professional, IT professionals. Under the category of IT, I'll tell you something I've learned in the last 3 years about IT. And my dad, who started off in the masonry company, ended up going to a technical school in the 60s and becoming a computer hardware guy and then a network guy in the 90s. And I just learned this in the last 3 years, I think because the world keeps changing, obviously, with technology. So under the umbrella of technology, you have your network resources firm, your IT network support, hardware, servers, computers, peripherals, keeping that network running. And that's what IT was for a lot of years. But now there's cyber security threats. And I had a contract, how I learned it 3 years ago, a contractor in LA get hit by ransomware, and their network support firm wasn't able to help them out. So they called me and we got our cyber people on it and they helped them out. But they stayed with their network firm. And 3 years later, they got hit with ACH wire fraud. Now, this is crazy. Now, I want to tell you, listen to this. What happened was somebody hacked into their Outlook, like we all use Outlook. Somebody hacked into their Outlook, watched their Outlook traffic for a period of time, like a month or two, figured out who was who, went into the AR collections person email of this construction company, sent a legitimate email, 100% legitimate email from her email to the customer saying, "Oh, I see you owe 1.2 million over these three invoices. We've changed our wire instructions. Send your money here." So the email was with new wire instructions. And that customer sent 1.2 million to the bad guy. And what happened was there were holes in their Outlook. So Microsoft sends patches very regularly, I guess. They send these patches that open up these new holes for these hackers. So they contacted their IT firm, and again, they couldn't help them out. They contacted us. We could help them out. And for like 5 or 7 grand, our guys patched the holes up, and then there's like ongoing maintenance that they are providing. It's cyber stuff. And one thing I can tell you that will help you mitigate, because now the question is, who's responsible for that loss of $1.2 million? I talked to our people, and my company, the experts in my company say, our contractor is responsible because your contractor is responsible for maintaining a safe network environment. And the email that went to the customer was a legitimate email. So they said that they've seen in litigation, technically it's our client that's at fault. The way it worked out in this real world story was my client and the customer split it evenly. They split that loss evenly. But, and there's business reasons for doing that to keep a good relationship both ways, I guess. But if that customer wanted to press the issue and lawyer up, they would have won. But what you can do is anybody in your office, certainly in your accounting and finance department, put in the bottom, like, you have a signature block with your company address and all that. Put words that say something like this. We will never send you changes to our wire instructions via email. If you feel that our instructions are going to change, or call our office, please call our office. Please call our office for any changes in wire instructions, something like that. You put it in your signature block. That'll mitigate the liability because now the email gets sent by the bad guy if you get hacked. Better to not be hacked, have the holes patched up. There's a way to do this. That's outside of my knowledge base. There's ways to do it. But if you do get hacked and you have that in your signature block, now at least you've mitigated your liability because it says in every single email you send, we will never send you changes to our wire instructions via email. Please contact our office for any potential changes in wire instructions. So anyway, there's a story that's happened in the past 12, 18 months on ACH wire fraud. Yeah, so building your network, incredibly important. So referrals offline. Yeah, I probably could. I mean, on the HRAT, I have them all in-house. I have them all within Eide Bailly. Eide Bailly has my lady in the Midwest, and we have IT people on the network side and the cyber side. But you can Google it. If you don't want to, get Eide Bailly people, you can Google it and find people. Just reading the question there. So that's it on, I think, building out your network, how incredibly important it is to have a very good team. You got to have a good team inside your organization and surrounding you, the professionals that are surrounding you. Next slide, Rena.
This is the last slide.
Is that it? All right,
Yes.
well, we'll put that up there, and then I'm going to roll onto some other notes I've got here real quick. I think we've covered a lot of what I had in these notes, and that's all good, the tax stuff. All right, so on taxes, I didn't really talk about tax planning, but you should be contemplating tax planning if you're a 1231 year-end S corp, as most of my contractors are. When you get into November, that's the time to be looking at 9/30, October 31st financial statements. Into December now, we're doing it now too. But you should be doing tax planning to avoid the April surprise. As George was saying before, you're going to pay taxes on all of your income, whether you distribute it or not. And especially if like your cash basis, you're not doing cash basis financials, you're doing percentage of completion. So your cash basis situation could be very different than your percentage of completion financials. Plus, there's things like depreciation adjustments that get done where you might have taken all this bonus depreciation buying equipment the last 3-4 years. All those deductions were taken a few years ago. You're not going to get the benefit now. There's these add backs for depreciation. There's add backs because even though you have depreciation expense in your financial statements, you took those deductions 2 or 3 years ago. Got to add that back. So there's all these different changes between your financial statements and tax terms, including for cash basis method of accounting, that you might get surprised in April. So even if you're having a tough year on your financial statements, you may have a positive cash basis tax income year and you don't know it. So it's a good idea to have your CPA do some projections for you so that you don't get that April surprise. So I'll make that comment. I'll also tell you never do anything purely for tax purposes. Oh, should I buy equipment? It's a big deduction, right? Yeah, if you need it. If you were going to buy it in January or February anyway, might as well buy it in December and get your 2024 deduction. But don't buy stuff just because you're trying to save taxes purely, right? That doesn't make sense either. Always do things for good business purposes, not for tax purposes. We've talked about these things already. I'll say this again and highlight it with your bond agent, bond company, banker. Again, treat them like a valued business partner that they are and communicate with them regularly. Share your financial reports every quarter. We've touched upon that. What's a nice idea? I'll tell you what a nice idea is in the November timeframe, maybe early December, schedule a meeting. And if it's difficult to get everybody in the same room, you can do this via Teams. I've done them here in the last month via Teams and in person. Get your bond agent, your CPA, your bond company, your banker on the line all together. Spend 45 minutes, an hour going through the year just passed, going through the year ahead, and just touching base, getting questions, asked and answered. Go through maybe any of your larger underbillings, go through any, interesting jobs that are on the boards. Just a nice touch base meeting. I've got a nice subcontractor that they take us to a country club and we get around basically in a boardroom. A few weeks, well, it's probably about a month ago now, after the meeting, a few of us went and played 9 holes of golf afterwards. I mean, relationships are so key in everything, and especially, including here in the construction business. That once a year meeting with your business partners is nice if you can swing that. I'll also tell you, you have a business, which I like to put this out there every once in a while to my contractors. Say even if you've got, 20 employees, I know there's a lot of contractors in this room, maybe 20 employees. You are really responsible for like 60, 65, 70 people, give or take. It's a broad calculation. It's all the people that rely on your company. It's a great responsibility. You are feeding all of these people. You're educating them, paying for college tuitions, private school, sports, entertainment, vacations, the mortgages for everybody. I mean, there's, living under that roof, there's a lot of people you're responsible for. And, keep that in mind as well, as you operate your business. It's not to put pressure on you. It's to say, hey, it's a really important thing you're doing. Thank you for running a business and creating these jobs that provide for families. Um, Along with that, I'll say, when you're an owner of a business, any business, this isn't just construction, when you're the owner of a business and you're taking compensation, keep this in mind. You are not just getting paid for your services as the owner of a business. You're also getting paid for the risk you take, and you take a great deal of risk. It is great risk and great reward. You could easily go out of business and go bust. And I've seen that a few times over the years. I mean, mostly it's successful, but you could, I mean, you could go that direction too. So you're getting paid for your risk. When anybody looks at your compensation, if you ever have anybody raise an eyebrow, you're getting paid for your risk too. You lose money in a year, and I'm sure many of you have lost money in a year. It hurts. Your employees are going to get that paycheck regardless of whether the company is successful or not. With regard to bonuses, don't pay bonuses if the company is not successful. Don't ever get into bonus arrangements that are based on gross profit. You got to look at the bottom line. It's got to be that the golden goose is successful. Don't ever put yourself in a position of paying out bonuses when you lost money that year. Makes no sense. So you have to put a bonus system in place that very strongly recognizes the bottom line, because that's what it's about. And if the company is not making money, to pay outside bonuses doesn't make any sense, or meaningful bonuses to anybody doesn't make sense. What else do I have here that I can talk about? I've touched upon these things already. So I have other sections as well, that I will touch upon here. Fraud and embezzlement. Yeah, let me talk about fraud and embezzlement in the construction industry. So I've seen this, and I've caught it personally. I've caught it over the years. I'll give you a few stories. So one of the nice things about having, in my earlier example, the small business where the wife's doing the accounting, at least you have somebody you trust dealing with the accounting and the financial operations, somebody you can trust. If you have an employee in that controller position, that accounting manager position, understand that he or she, especially in the smaller contracting environment where there's lack of segregation of duties, there's a possibility they could steal from you. You need to provide oversight. I'll give you another old saying: employees do what we inspect, not what we expect. And so you need to have strong oversight. You need to be involved. Do not delegate the responsibility of oversight of the financial operations. You can delegate these tasks, but you better be involved, because I have seen people get ripped off. I had one lady where I suspected she was stealing, and the long story short is she was. And she would not give me access to bank statements. She would not give me the information I was asking for. And I told the owner, hey, I'm getting stonewalled. I'm feeling even worse now about this. I need to get this stuff. I'll come in at nights and weekends with you and go through it. And I did. And once I got to a certain dollar amount, I could have kept going. He stopped me. Most of the time, these people don't get prosecuted. So those people in those positions, there's a variety of different tactics. Here's another tactic. There was a case where a controller on the payroll records was adjusting the withholdings, federal and state, on all the employees, decreasing them, and by an equal amount, increasing his. So the net was correct. Then think about this. What a crazy thing. The net was correct, but his federal withholdings were higher, let's say, than everybody else. Then even his was really getting done in his paychecks. So when tax return time came, he got a big refund. People were owing money who maybe shouldn't have owed money. So I hope I'm explaining that clearly. But there's all sorts of ways embezzlement and fraud can happen. I had a president of a very large subcontractor. The guy just rolled into the company earlier that year. And I'm doing the year-end meeting. And I was talking about trend analysis. So I look at trends. Like I know what material should be in that subcontracting company. I know it's approximately one third. It's like 31% of revenue. This material number spiked up to 51%. And this guy was the president. And I suspected something was very off. So at the year-end meeting, we have the owner, we have the president. This guy, by the way, gave himself a $25,000 raise by himself. He was very type A kind of guy. He gave him this big raise, was looking for 5% of the company. And we're in this meeting and I'm going through the fluctuation analysis and I go, well, why did the materials go up 20 points? 20 points. I mean, and it's a large subcontractor, so the math was big. And he gave some quick BS answer and he moved down to the next line and he moved down to the next line. And he's just doing this dissertation about all these expenses, blah, 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 blah. And kept going for like easily 10 to 15 minutes. And at the end of it, I said, that's great. What about materials? Going up 20 points because I'm not satisfied with your answer. I think there's something else going on here and I'd like to understand it better. Literally, this guy started blotching up on his face. He moved his chair back, stood up. He was sweating now. Now he's just like sweating. He apologized for some rare skin condition, which maybe he did have, and that's why he was blotting up like that. Walked out of the room saying he needed water. 2 weeks later, he left the state. He left the state, although I learned he stayed in the industry. And again, the owner didn't want to prosecute. What do I think happened? I think it was a kickback scheme. I think what was happening was this guy was a very good golfer and he was golfing with suppliers. And I think what he was saying was, hey, we need these materials. We need 30 grand, but bill us for 42 grand. Bill us for 43 grand. We need 40 grand, bill us for 60 grand. I'm pretty sure that's what was happening. And so legitimate invoices were coming into the finance department, legitimate invoices, legitimate approvals by him, and they were paying out all this money. So be vigilant in your business. Key people, taking customers, uh, doing side work, sometimes using your laborers. I mean, I've seen all sorts of crazy things. So just be vigilant out there. Again, it comes down to good character people working with them. So be careful, as careful as you can. So exit strategy planning. Eventually, you're going to exit the business. I touched upon that. I'll list out some different ways you can exit. A direct sale to key employees over a period of time. You take the note. Direct sale to outside third parties. By the way, this is uncommon. Outside third parties in the construction business. Contracting firms are difficult to sell. The assets wear shoes. It's not like these are machines in the manufacturing environment just producing consistently. Difficult to sell, but that, again, it's probably going to be an asset deal, not a stock deal. Sale to an ESOP, probably for mid to larger contractors, but again, I think I touched upon that earlier. ESOP is a good model, a good option for contractors. I think it's the fourth largest industry in the ESOP space, where transactions are executed. So it is something that it's got to be in the right circumstances. You got to check all the right boxes. You got to have a fair valuation. I strongly encourage seller financing, not bank financing, to finance the deal, to keep the bond company happy, to be flexible on the debt repayment terms with the permission of early repayment if results warrant and the board approves. So, ESOP's an opportunity. You can just simply wind the business down. That's an option as well. A lot of times it's estate planning transitions to children in the business. And like I referenced earlier, I've got a handful of cases. I've got a number of cases where I'm working with the children of the owners I was working with years ago. Now I'm working with their children. And you use estate planning to gift stock to the children. That's another option for exiting the business. And I think that's about it. We've got about 10 minutes left for some more Q&A. Samantha, thank you very much for that comment. We've got about 10 minutes for Q&A. You've got me here as a longtime construction CPA. If there's any questions you've got, let me know. Here, again, we've got 10 minutes if you want. You can unmute yourself or put a question in the chat box about anything to do with any of the areas we touched on or anything else. And I'll turn it back over to Rena. I don't think there's any other questions. Unless I missed one.
I want to give everyone just a gentle reminder that tax season is coming up. So any questions that you have the perfect opportunity to ask a CPA, a construction certified CPA. So if there are any questions, I'll monitor the chat. I want to just give everybody a last call for questions. Even anything you're curious about, if you want clarification on anything that was spoke about during this presentation, last call. Oh, okay, I see two questions. Does the profit first strategy work in construction?
Yeah, I'm not familiar. If profit first strategy is a specific strategy, I'm not familiar with that, Sheila. If you want to unmute yourself, we can have a quick dialogue about that. But I'm not familiar with profit first strategy. I would say it sounds great. Profit first and foremost, profit always, good profits. I'm not familiar with that specific strategy, but again, if you want to unmute yourself, we can dialogue about it. The next question here is for an asset sale. What does a GC normally have as, was that Sheila? No. What does a GC normally have as assets? Yeah, this is a great question, Enrique. Yeah, there's not a lot. So, it could be the backlog. All right. So a general contractor has backlog, and so the contracts that are in process could be purchased. The employees within that contracting firm would come along as well, most likely. The backlog is really the big thing in a general contracting firm. You're selling your backlog, and then you're subtracting. Generally, from a valuation perspective, the way I value a contractor is I look at the backlog, the value of the backlog, and then I back out the cost of administering that backlog. I'll add in for some contractors a kicker for goodwill. And I'm telling you, I do this method. If I have good financial statements and job schedules and backlog information, I will come up to really close to what a professional valuation firm will do that'll charge you 25 grand for. I can do it really, really quickly if I've got that information. But the backlog is the biggest one, Enrique. Employees, customer relationships, customer list. If you're regularly doing work with customers over decades or years even, that customer list has value to it as well. So uh, cost for review again for Elton. For the smaller contracting firm, it's probably in the 18 to 25 grand. I've got contractors I charge upwards of 40 grand for, but probably the 18 to 25 grand range for the review. Again, that's not to fix your accounting, that's just to do the review. Anything else? Any other questions?
I want to thank
Hello.
there's more. Sheila just clarified her question a little bit. She said, based on the book.
Oh,
Hello. Hi, Glenn. Thank you for such a great presentation here. David here at the Insky Construction. I think one of the colleagues here was asking a question about profit first. Okay, so I think what that person meant is how um, do we manage, to make the profit always, right? Because like you can't really spend profits, all right? What we can spend is it's actual cash, right? So like the profit is kind of theory, and once we have the cash in our account, this is a fact, okay? So I think with the idea of making profit, are there any ways that we can always, or maybe you are familiar, that we can always either set up a system that we prioritize the profits, so we maybe make allocations in our bank and deduct
yeah.
percentage from every deposit that we make towards the profit, and then if our company have after distributions to owners and maybe making some percentage towards tax liabilities as well. And
Yeah.
then maybe when we can see that operating costs are not enough to pay for our business operations, maybe there's a way to control it better.
Sure. Yeah, thank you, David, for that question. So Sheila did add that it's a book called Profit First by Mike Michalowicz. I've not read that book, not familiar with the philosophy of that book. As to David's question, David, you asked a very good question. So here's the problem, and here's where business owners, regardless of industry, can get into trouble. You have cash in the bank. You see all this cash in the bank, and you might spend it elsewhere, take it out, distribute it to yourself, because you see cash in the bank, which isn't necessarily tied to all the profits, you know? Um, the problem is that's not all your cash. Just because the cash is in that bank doesn't mean it's cash for you to be able to use to spend on distributions or other ventures. The way I would answer it, David, and you can come back online and tell me if this is helpful to you. First of all, think about your balance sheet. You have the other side of the balance sheet, which is liabilities. So you have all these accounts payable, you have accrued expenses, you have debt, you have all these other things you need to pay. So that bank account, that is the results of your cash receipts. Let's disperse
Dispersion.
it. It's just a picture of one
You
day
know how to
one
use
month
QuickBooks?
in the bank. Again, it's not all your cash. So also in your question, you mentioned distributing money for taxes, but also above and beyond taxes. Let me emphasize again, do not make distributions to yourself other than for taxes generated by the operating company that you're distributing from. Don't distribute money for taxes for other tax liabilities elsewhere in your personal life, only for the business operations. Until you get to that ratio I talked about, which is your equity, your stockholders' equity is at least as big as your total liabilities, you should never distribute anything other than taxes. And again, ask for permission if you're not sure. If you see, and I see so many business owners get into trouble because they have so much cash in their bank account, but they're not really recognizing the liabilities. Oh, and by the way, in a construction firm, another liability that you don't really see unless you're looking at your financial reports, your balance sheet, your job sheet, overbillings. Overbillings. You might have overbilled. You still owe work. Not only do you owe your vendors and accounts payable, or you owe accrued expenses, or you owe debt, you also owe work. You have to, especially a general contractor, you bill in advance. You owe work. You still got to put materials and labor in place. You got to put that stuff in place. So do not ever look at the size of your bank account and go, oh, wow, I'm doing great. It's not about your cash. It is truly about your accrual / percentage of completion basis profits. Those financial statements, profit is real, by the way. I think you said profit is theory. Oh, I disagree with that. I think profit is absolutely real in that when you bid work, if you're bidding correctly and you're estimating well, that is the profit on that job that's going to pay your back office overhead and your profit. But you've got to retain that profit until your balance sheet gets again to that strong position. And these financial statement, the balance sheet metrics are healthy and very strong. Once you get there, then you can start distributing above and beyond taxes. But you've got to get there first. Go ahead, Debbie.
Great. So tell me this, is it possible that the accounting reports can show that the company is profitable, let's say, but we don't see the cash in our bank account?
100%. It could be sitting in your accounts receivable. It could be sitting in your underbillings. It could be sitting in your retention. One thing I haven't said until this good question is, a lot of times I say it to my contractors, you're the bank. Like, say it's ABC Construction Company. You're the bank of ABC. You're a financing company. You're financing work. You're financing labor materials. So you can have profit, but not cash. It's sitting in receivables. It's sitting in retention. It's sitting in underbillings, as long as underbillings are good quality underbillings. Yes, you can have good profit without the cash because you're not collecting timely. You're not billing timely. You're having change order issues or whatever the story is. You're doing work on change orders, but not getting them approved quite yet. So you can have profit, but at some point, if those receivables aren't good or the underbillings aren't good, some of that profit is going to become loss. Real quick, as we have just a few minutes left here, anybody else have any questions? I'm going to come back to David because he's asking good questions, but anybody else have a question before we have the official time get called on us? And if not, we'll come back to David. What else you got, David?
Well, that's actually my kind of main area here to ask, because I think that like the profit itself is kind of a theory unless we really have this cash in our account and we see that it's there, so we can have better view on how the business is doing, so we can reward ourselves for the work that we do, beside contributing to our salaries. Okay, so would you, let's say, be open to work with a contractor who would like to set up a system where I would, let's say, like to prioritize profit, and from, let's say, every deposit we would set up percentage, maybe even 1-2% for a separate account, and just to kind of monitor these things along the way, just to make sure that there is always that we prioritize profit, then the owner's distributions, and taxes, or maybe the other way.
Yeah.
But,
So let me come back to the profit theory comment. I think I'm going to maybe revise if I'm thinking about it correctly and differently now. Profit is a theory until it's realized.
yeah,
Profit isn't profit until it's cash in the bank. You can have your receivables, you can have your underbillings and retention, but until, I won't use that analogy, but until it's turned into cash,
yes,
it's not real. This is true. This is absolutely true. This is why it's very important that billing and collection practices, that we're on top of our receivable list, that once the receivable goes 31 days, 40 days, somebody's on the phone calling or emailing. You've got to stay on top of it. You've got to be diligent on your AR and your WIP, your underbillings, your retentions, because until it turns into cash, it is just theory. And if that's what you mean by that, I agree with that.
So what I'm
Yes.
saying is, like, let's say that if we set up a percentage that we want to make, let's say our targeted percentage is, let's say, 8%, right? And from every, and this is just a theory for now, just an example, right? And let's say we deposit to this new separate account, let's say, for now, 4% towards profit from every deposit that we receive, right? And if at the end of the year we see that we cannot, or we don't have enough money to pay for operating expenses, would it be right statement to say that in this case we have to look into our operating expenses and to see maybe we need to kind of make our business a little bit lean and remove some expenses? Because how otherwise do you know whether your business maybe have too much of overheads that you don't need?
The answer to your question there is possibly, because
And
another possibility is you had the profit, you just didn't
pause.
collect it. If you can't pay your expenses, it's because you didn't collect the cash. You may
Mm.
be cash poor, but AR rich, underbillings rich, retention
Yeah.
rich. In terms of how do you know that your business is right size in terms of overhead, I get back to that one slide where we talked about your SG&A being 8 to 12%. If you're at 15, 16%, you're either too high, or here's another good example. I've seen a lot in the construction industry, a lot of family members get employed. 5, 6, 7 family members. Guess what? Not all of them are productive. I have people
Yeah.
who are in high-level executive positions who maybe don't have the background to be in that position, but they're the brother, they're the sister. So there's excess overhead that shouldn't be there. Or it could be discretionary. It's 15, 16, 18% because it's just discretionary spending that can be easily cut back, but it really should not be that high.
Mm.
And so, David, a good measurement, if your gross profit is being achieved and you're executing in the field and you're hitting your targets that you bid on, but your SG&A is too high, well, then, yeah, you have to right size your back office overhead. It's all about efficiency and productivity and having my organization right sized in the back office. And if I have all those things dialed in, I'm likely going to be successful and profitable. I just will be. I mean, but you have to monitor all these things.
Yeah, I think, and that's what you can help with, is to actually measure, because unless we don't measure, we won't know, right?
Yes, like what you inspect, not what you expect or hope for. You have to inspect and stay on top of. That's why monthly financial statements are better than quarterly, because I can get my information more timely than having to wait every 3 months. I can see it every month. So if I'm off track, I can get to the problem quicker by doing monthly financial statements. But these are good questions. And this is exactly where a good financial reporting system can give you the information as the CEO, president of your company, to be able to make the decisions to right size where I'm spending too much. And then fluctuation analysis year over year. How come last year in entertainment I spent this, but this year I'm spending this much? Establishing proper baselines. These are good baselines. Now I'm deviating from the baseline. So it's about data, and how we analyze that data, and how quickly we get the data, and how accurate and good quality that data is. So yeah, these are things a reporting system can absolutely help you do to better manage your business and help you become best of class contractor. Absolutely.
Great. Thank you, Glenn, so
I
much.
got a I got a question for you.
Thank
Yeah.
you.
Can I
Can I
ask a question?
interject really quickly, and then I promise I'll let everyone go back to their conversation. Please take a moment to fill out the survey. The survey provides valuable feedback for us to let us know how the training went, and also just for future info on future training or future feedback on future trainings.
And then I'll also
Oh.
say real quick, if anybody wants to contact me, I don't know if my email address is anywhere, but LinkedIn, you can just type my name into LinkedIn. You're going to catch me there. You can message me on LinkedIn. You can send me an email. My email address is my first initial G, last name Carniello, Carniello @eidbailly.com. That is spelled EID as in David, EBAILLY.com. I don't know if we have a slide there, but
We do. I want to say thank you, first of all, to Glenn for taking time out of his afternoon to engage with our contractors and provide his valuable insight and feedback and all of the expertise that you had provided. It's things that you cannot find in a book. So it's very good that you're able to kind of come here and communicate this information to us. Thank you to all the contractors who attended today for taking the time out of your busy schedules and for out of your holiday season to come and learn more about your taxes and how you can improve your business. Thank you. And I'm not going to close the Zoom room. I'm just going to have the survey up. And if you guys have additional questions and if you're still available, if you have to go, I completely understand. But if Glenn is still available to answer questions.
yeah, I'll stick around.
So I got a question about the review. I'm like in my first year of business, and I'm in a bonding program currently, just off of internal financials, in-house financials. And so I'm on the fence of like, do I take the step to go to a review? How does that impact my bonding situation, or I guess trying to figure out what is the pros versus cons of like making that decision when it's time to do a review?
Yeah.
I'm in a meeting.
Good question. So Darmel, the answer to that question is don't offer a review to anybody. Don't offer a review to your bond company or your bank. Don't offer that because it costs money, right? And the only time I would do the review is when I'm asked for it. If you're getting the bonds you need anyway, then don't do the review. I oftentimes when you're doing bonded work, you're going to be required to do a review. But I'm of the belief that unless I'm asked to do a review, I'm not doing it if I'm getting what I want anyway. Now, can a review help you? Yeah, it could help you, get maybe better pricing. But again, at the end of the day, it's about your financial statements. The financial statements inside that review better be good quality. You better have a good balance sheet. You better have good performance. You better have a good track record. You better have the technical ability to execute the work that you're looking to work on. Bond company's going to analyze all of these things. But in terms of when to get the review, when you're asked for it is my summary answer. When the bond company or a bank, because you're asking for, if you're getting like 300 grand line of credit, you probably don't need a review. But if you're asking for 750 grand, maybe even 500, but certainly 750 grand or more, probably the bank's going to ask for a review. And again, when the bonding is significant enough, they're going to ask for a review and they'll get you there pretty quick. But I'm of the belief, don't offer it. Don't ever offer an audit because that costs a lot more than a review. It helps the CPA firm, but again, if you're not being asked for it, don't do it. You can get a lot of value that we're talking about here in this meeting just by having good financial statements and a good internal accountant and a good CPA that can help you analyze all this stuff, just like we've been doing here this afternoon and evening. You can get the same value and the same information without doing the review. The review can help, by the way. I mean, when I'm doing the review, I am doing fluctuation analysis. I'm looking at the job. So at the year end, I am bringing value in my reviews. It's not just pure compliance. However, again, we can do that without doing the review procedures, just looking at the financial statements. So hope that answers your question, Darmel. Any other questions before we wrap it up? Anybody else?
I think that's it for
We're
tonight.
good.
Thank you,
Yeah.
Glenn. Thank you, everyone, for attending. We appreciate you so much. And thank you, Glenn, for taking the time out of your holiday season.
Yeah.
Have a
Happy holidays and Merry Christmas. Thank you.
Have a happy holidays.
Bye, everyone.